Hi everyone. We're going to cover in this module how to prepare a master budget. In this project, we're going to create a trial balance as of December 31st, 2020 for the company Husky Co. Now they just started their business on October 1st when they sold 30,000 shares of $10 par common stock for $2.8 million. They immediately turned around and purchased $2.4 million worth of manufacturing fixed assets and $200,000 worth of administrative fixed assets. By preparing the trial balance for December 31st, 2020, we set the stage for preparing a budget for the whole year of 2021. Let's first look at the trial balance that occurred on the first day of their operations when they sold the stock and purchased the fixed assets. Now remember that they sold $2.8 million worth of stock. Here you see where they bought $2.4 million worth of fixed assets for manufacturing and $200,000 worth of fixed assets for the SG&A, or selling, general, and administrative uses. Now 2.6 million is obviously not 2.8 million, so they still had cash worth $200,000 left over. How did I get this 300,000 and 2.5 million? Well, remember they sold 30,000 shares worth of stock that was $10 par for $2.8 million. The 30,000 at $10 is $300,000. And then the remainder is additional paid-in capital, the $2.5 million. And that's how you break it down. Now remember that all changes to accounts must be done through journal entries. And so I've listed here a sequence of journal entries made in the fourth quarter of 2020 in order to bring us to December 31st of 2020. Now, the first one is when we make our sales, we collect half of the revenue in the quarter of the sale, and then the other half in the following quarter. And this is how it looks in a journal entry. For the selling, general, and administrative expenses, obviously expenses are listed on the debit side. And then we spend $97,000 in cash. The accounts payable was $6,000. And we wrote a journal entry depreciating our SG&A accounts, fixed assets, for $5,000. How did I get that? The $5,000 is taking $200,000 worth of the fixed assets, dividing that by 10-year life. And so I have $20,000 worth of depreciation per year. Divide that by 4 quarters and you get $5,000 per quarter. We follow the same process on the manufacturing equipment. 10 years worth of life divided by 4 quarters, that gives us $60,000 of depreciation on the manufacturing equipment per quarter. Also, I purchased $410,000 worth of inventory, and it broke down by $304,000 in cash, $45,000 in accounts payable, and then of course the depreciation expense applied to that inventory. That said, I ended up selling $290,000, $509, during the quarter, and so that ended up being my cost of goods sold. And you can see the reduction of the inventory being posted on the credit side of the general ledger. Now when I take the sales of $420,000 minus my SG&A expenses of $108,200 minus my cost of goods sold of $290,509, that gives me net income of $21,291. And my income tax is 30% of that, which equals $63,87. Haven't paid it yet, but I have to accrue it. Also, when I look at my cash accounts, I haven't spent all of my cash. I end up with about a little over $7,000 worth of cash, and I have a policy of maintaining cash of somewhere between $5,000 and $6,000. Therefore, I have a couple of $1,000s worth of surplus cash that I can invest in short-term investments, and that's the last entry that you see there. During the fourth quarter, I sold 7,000 units at $60 each. That equaled sales of $420,000. Now remember, I've only collected half of that, but that's okay. We're not looking at the cash flows right now. We're just looking at the sales, the accrual accounting. And so I also have cost of goods sold of $290,509 that is deducted from the sales to derive gross profit. My SG&A expenses are $108,200, which leaves me an operating profit of $21,291. My income tax expense is 30% of that, so that's $6,387. So my net profit is $14,904. The next step of this process in step 1 is to create a trial balance at December 31st after we've closed all the books. That is, after we have taken the income and expense accounts and posted them into retained earnings. So this is what it looks like. You'll notice the debits are on the left. That is $2.938236 million. And the balance on the credit side equals the same. I have now accumulated $60,000 worth of accumulated depreciation on my manufacturing equipment, $5,000 on the SG&A equipment. I've got accounts payable of $51,945. I also have income tax payable worth $63,87. My capital stock is $300,000. My additional paid-in capital is $2.5 million. Both of those accounts are the same as they were on October 1st. And then I also reflect my net income of $14,904 in the retained earnings, and it comes from the income statement. Now I can start looking at what my budget will look like in 2021. To do so, I have to first of all figure out what was my projected sales. In this case, I look at the last quarter of 2020, which is 7,000 units sold, and that's an actual number, not just a projection. But the projection occurs in 21 and 22. And so each quarter, you will see what the projections are. In this case, $7,000 in the first quarter of each of the years 2021 and 2022. $8,000 in the following quarters, and then $12,000 and $16,000 for 2021 in Q3 and Q4 respectively. That's where we have to start in order to build our budget. Continuing step 2, I need to prepare the budget for sales, production, direct materials, and direct labor for 2021 using the following information and templates. Remember that the sales budget for each of these Qs were developed in the last slide. So I have an annual total budget of 43,000 units being sold. Throughout the year, they will be sold for $60 a piece, and so my total sales will amount to $2,580,000 for the whole year. Moving to my production budget, I have to first of all decide on or take into account the sales that I'm going to have in the inventory, but also I have to have an inventory at the end of the period that will take me into the following quarter. Our policy is to have 20% of the following quarter's sales as my desired ending inventory. And so if I look at Q2, my sales is expected to be 8,000 units. 20% of that is 1,600 units, which I will have to have in my ending inventory. But if you'll recall, I had 7,000 units worth of sales in Q1, and so my ending inventory at the end of Q4 of 2020 would have been 1,400 units. And so I get to take that away since I don't need that here anymore. In other words, there was a change in my inventory of 200 units in Q1. That means that my production has to be 7,200 units, not the 7,000 worth of sales, but the increase of 200 in my ending inventories. And that follows through each quarter. I get to add in 20% of the following quarter sales and deduct my beginning inventory. And that change in inventory feeds into the production budget. So if you look at this last section here, the annual column, where did I get these two 1,400s? They look the same, but they're actually different in that this 1,400, my ending inventory, is basically derived from this Q4. The Q4 inventory is based on $7,000 worth of sales contemplated in Q1 of the following year. And this 1,400 reaches back to the beginning of the year that I carried into the year from Q4 of 2020. That's why they look the same, but they're totally different. And if you were looking at a real company that had different budgeted sales figures, these two numbers would be different. The whole point is that up here, this has to come from Q4 ending inventory, and down here, this 1,400 has to come from Q1 beginning inventory. In constructing my direct materials budget, I have to make sure I understand what one unit requires. Each unit requires 2.3 pounds of input materials costing $1.45 per pound. So your raw materials requirements in pounds must be 2.3 times the required production, both for production and inventory balances. Therefore, the budgeted production in Q1 of 7,200 units required 16,560 pounds of raw materials. That is 7,200 times 2.3. In anticipation of this level of production, 20% of the 16,560 pounds was left in the raw materials inventory at the end of the previous quarter. This was the current quarter's beginning inventory. Following the same process, the ending inventory of raw materials must be 8,800 units. That is times 2.3 pounds times 20%, which is equal to 4,048. When we go through this, we've got 4,048 in my ending inventory, 3,220 at my beginning inventory. That means that I had to have 17,000 388 pounds of raw materials. Remember, they cost $1.45 a pound. Therefore, my total cost of direct materials is $25,213 in the first quarter. When I go through this process for all 4 quarters, I come up with an annual need of $143,405 for direct materials. I come to the direct labor inputs, and we're told that each unit requires 45 minutes or 75% of 1 hour to build at a rate of $17 an hour. So if we look at my units produced of 7,200 this quarter, times 0.75, that's 5,400 hours, times 17 is 91,800 indirect labor. For the year, that's $548,250. We will now prepare our manufacturing overhead budget. The overhead budget includes a variable component as well as a fixed component. Now, the fixed component is given to us at $270,000 per quarter, and so this is what it amounts to, is $1,080,000. This includes depreciation of $60,000 per quarter. You may recall that calculation in a previous slide. It also includes a variable component, 40 cents per direct labor hour. And if you'll recall in our previous slide, we had 7,200 units produced in Q1, and it took 75% of that number, or 5,400 hours of production. That's where we get the 2160. The total for the year will be $12,900 in variable overhead and $1,080,000 in fixed manufacturing overhead. To calculate our budget for the selling, general, and administrative budget, that is the SG&A budget, we take 1% of sales in dollars plus $2 per unit sold. That's the variable component. So if you'll recall, in Q1, our sales was going to be 7,000 units times $60 per unit, or $420,000. If you take 1% of that, that's $4,200. And then if you take $2 per unit sold, that's 7,000 units times 2 is 14,000. That's where we get the $18,200. The $14,000 plus $4,200. The fixed SG&A is the same, $90,000 per quarter, for a total of $360,000. For the year, our SG&A budget will be $471,800. Step 4 in building our budget is the compilation of a budgeted income statement by quarter, and this is what it looks like. We go back to our sales budget, where we pull the information for each quarter. Then we look at our cost of sold budget. Now, the cost of goods sold has a formula. It's 2.3 times 1.45. If you'll remember, that is the formula for the raw materials, plus 75% of each hour times $17. That's the formula for the direct labor. And then we have direct labor times $0.4, which is the variable overhead, plus $25 per unit. And that gives us the cost of goods sold. We take this times the 7,000 units that we sold, and that becomes our cost of goods sold. We do this with each of the amounts sold. This is 8,000 units, if you'll recall, and so forth. for a total of $1.784 million from the $2,580,000, and that gives us a gross profit of $795,445 for the year. Our SG&A expenses come next. How do we get that? The units sold, which is 7,000 units in the first quarter, times $2, times the sales, plus the sales, times 1%, plus 90,000 in fixed SG&A expenses, and that's where we get the 108,200. The interest expense in this case is zero. We have designed this to where we're not going to worry about interest on any loans. The taxable income is $21,291, and a third of that, not quite a third, it's 30%, goes to the federal government as income tax. Again, this is not yet paid. This is the amount that has to be accrued in the first quarter, and so our income for Q1 is $14,904. For the year, it will total $226,551. Step 5 involves developing the cash budget, and it is one of the more challenging and involved steps in the whole process. First of all, we need to understand some of the things that affect the cash budget. And so you're given a list of things that you have to figure out what to do with in developing this budget. First of all, we have a capital budget. Equipment costing $300,000 will be purchased at the end of Q2, and it's paid in cash. The equipment will not be placed into service for purposes of depreciation until after the end of the year due to a long time period for installation and testing. Other cash items, we need to understand that the tax rate is 30%. We also need to understand that the beginning cash balance should be between $5,000 and $6,000. The company intends to maintain this level of cash at the end of each quarter. If the cash balance exceeds $6,000, the surplus is moved to savings in $1,000 increments at the end of the quarter. Normally, a revolving loan would bear interest for the outstanding balance. For purposes of this exercise, we will ignore such interest expense on revolving loans. That said, if the ending cash is projected to be insufficient, that is lower than $5,000, loans are taken out at the beginning of the quarter in increments of $1,000, bearing a simple interest rate, in this case of 0% per month. The interest is paid in the quarter following any quarter where an outstanding loan balance existed. Loans are paid back at the end of the quarter whenever surplus cash exists, again in $1,000 increments. All components of cash cost of goods produced, that is direct materials, direct labor, variable manufacturing overhead, and cash SG&A are paid 2/3 in the quarter incurred or purchased and 1/3 in the following quarter. To calculate the Q1 variable manufacturing overhead, take the previous quarter's production, that is $7,000 units plus 1,400 units or 8,400 units times 0.75 times 1/3 and add that to Q1. Fixed manufacturing overhead and fixed SG&A are paid 100% in the quarter incurred because, after all, we can anticipate when that's going to happen. Depreciation must be subtracted from the total fixed cost to derive cash costs. So, in the area of fixed manufacturing overhead, remember we charge $60,000 per quarter. So the cash fixed manufacturing overhead is $270,000 minus that $60,000 in depreciation, or $210,000 per quarter. The fixed SG&A is $90,000, of which $5,000 is depreciation. So we will only have cash fixed SG&A of $85,000. All fixed assets are depreciated over 10 years, that is 40 quarters. However, the new equipment purchased in Q2 2021 was not placed in service by 12/31/21, so no depreciation was recorded on the equipment for 2021. Sales are collected 50% in the quarter of sale and the balance in the following quarter, and taxes are paid in the quarter following the quarter incurred. This is what the cash budget looks like after it's populated. You may recall on the 12/31/2020 trial balance that we had cash of $59.09. That's where this comes from. So I have to look back several slides to find out where I got that number. Remember, we sold $420,000 worth of sales, and we collected $210,000 of that in this quarter. Where did this $210,000 come from? It came from the previous quarter, the Q4 2020 accounts receivable. And so even though they look the same, they are from different quarters. This being from the previous quarter, this one being from the current quarter. You can see that play out over here when we have different amounts being carried forward. This carried forward from the previous quarter, Q3. This one is half of the sales of Q4, and you'll have a $480,000 number in accounts receivable carried forward into the following year. The direct materials, if you looked at the direct materials in total, you would get the sum, you would get the sum of $16,000, 2/3 of this quarter, plus $8,000, the 1/3 for next quarter. So these two numbers go together regarding how we incur the costs, but how we pay for the costs are reflected here. This $9,000 number comes from the previous quarter. And so the 21 and the 10,000 go together, the 29 and 14,000 go together, and so forth. Same with direct labor, 61 plus 30, 74 plus 37. Same with the variable overhead. And remember, this is the manufacturing overhead, and we're only going to look at the cash portion of that. So my fixed overhead is $210,000, not $270,000. The variable portion is, again, you stagger it. 1/3 is $720, 2/3 is $1440. Those two go together. The variable SG&A, again, you stagger it, and you only reflect the $85,000 in cash fixed SG&A. We come to the capital purchase of $300,000 in the second quarter. We're paying cash for that, but we're not putting it into service until the following year for depreciation purposes. We've chosen to ignore interest expense, our taxes. Now remember, we carried $63.87 into this year as a tax payable from the previous quarter. You can find that number on the end of year trial balance from 2020. Now we happen to make the same amount of money this quarter, so we carry a balance forward and pay it in the following quarter. In Q2, when we sell 8,000 units, we're a little bit more profitable, and so we calculate a tax expense that is carried forward and actually paid in Q3, and so forth. At the end of the year, we have paid $54,167 in income taxes, even though we've incurred a larger share of that. So our cash outlays amount to these numbers here, and after we pay for all that cash, we will have cash before financing of $19,000 negative. So we're upside down on cash in the first 2 quarters, and we have to decide where we're going to get the money to cover that deficit. The first place we turn is to the savings account. Remember, in Q4 we tucked away $2,000 into the savings account because we had a surplus of cash. Well, we'll go ahead and pull that money out of the savings account. And then we still have to borrow another $23,000 in order to get into our target cash range of between $5,000 and $6,000. And so we end up the quarter with $59.96. If you'll notice, all of these quarters end in cash balances between $5,000 and $6,000. In this case, we had to borrow $308,000 more in Q2 to get us back in our target cash position. And in this quarter, Q3, we end up with a surplus of cash. And we're able to pay down our loan a little bit. We've got $81,000 in cash before financing. We want to hold $5,000 back and pay down $76,000 from our loans. But now our loans are still pretty hefty. If you'll recall, we've got $308,000 here and $23,000 here. So this $76,000 is a nice down payment, but it doesn't quite liquidate the loan. In Q4, however, we are able to pay the rest off. We don't have any surplus money, but at least we were able to pay off the loan and end the year with no loans and no surplus cash. The next step in the process of building our budget is to reflect our 10-column worksheet. This is a tool that accountants use to go from an unadjusted trial balance to the actual production of financial statements. I've color-coded each set of columns for you so you can see how they interplay with each other. The unadjusted trial balance is just a listing of all of the accounts in the general ledger. They balance at the bottom. The adjusting entries are those adjustments that we post, and I'm not going to go into the details of where these numbers come from, but suffice it to say, these are the adjustments needed to correct the accounts. For example, the sales had no money in the account. Well, we know that we had $2.5 million worth of sales, so we're going to post that into the credit side of the adjusting entries. It carries forward to the adjusted trial balance because I'm going to take the credit here plus any changes over here, and that equals my credit balance here. If you look up at the top, I start with $5,909 in the cash account. I post a debit to the cash account to increase, that is from the collections of sales, and then a credit to decrease the cash account by those cash expenses that we had. And so I have an ending balance of $52.64. This carries over into my balance sheet. All of these figures from the sales account down all carry into the income statement. So again, the income statement is colored purple, the balance sheet is colored red. The difference between the income and the expenses is the net income. In this case, $226,552. And I post the debit here in the income statement and the credit here on the balance sheet. The credit will ultimately reside up here in the retained earnings statement, but this helps me keep all of my columns in balance. From my 10-column worksheet, I can now move to step 7 to build my pro forma financial statements. That is my budgeted income statement and my budgeted balance sheet. Here's my budgeted income statement. All of these numbers come directly from the 10-column worksheet that we just looked at. As well, this is the budgeted balance sheet that we draw from the 10-column worksheet. If you'll notice, the total of the assets is equal to the total of the liabilities and stockholders' equity. And again, these come directly from the 10-column worksheet. I have chosen a stacked presentation as opposed to a side-by-side presentation for my balance sheet. Either one will work, just according to your own preference. I hope this has made some sense to you. I know it's a very involved process, but budgeting is one of those key things that every organization should do on a routine basis. Not only that, once you put the budget together, you should also refer to your budget periodically to make sure that you're on track. Because after all, not only is the budget a good planning tool, it's also a good tool to measure your performance. Thank you so much for hearing this presentation.